Derval Walsh, you're a partner in the finance and banking group at Mishcon Thinks, and I'm hoping we can have a bit of a chat about the way you see the relationship changing between banks and customers and businesses particularly, because things do seem to be changing in the general mood and the behaviours.
I think the mood music has certainly changed over the last 5 years. It was once the case that customers had very close relationships with their banks, and in particular the relationship managers at the banks. I think that relationship has changed. It appears to be much more interventionist and not as collaborative as it once was, and in some cases the banks are being extremely aggressive actually in their dealings with their customers, so this is probably a change for the worst.
So give us a few examples of this change in behaviour.
Well, I have seen situations where established relationships going back 20 years have pretty much changed overnight, where banks have looked for, actively sought out what previously would have been regarded as technical breaches of loan facility obligations, with a view to applying pressure on customers to repay early, to pay higher fees, higher margins, various things which in the pre-2008 world would have been inconceivable and were certainly new to customers dealing with banks.
So why is this happening?
Obviously, when the financial crisis happened in 2008, things fell apart. So there was an incredible strain put on the banks. And I think that they got instructions from upon high that they needed to take whatever measures they could take to improve their balance sheets. And that often resulted in attempts to extract value from borrowers and customers.
So it's not just selling them new products, it's actually getting rid of them if they're not making them enough money.
Absolutely, and in some cases financial institutions have made a deliberate decision at a business level, at a management level, to exit a particular market. So for example, the commercial property market. What happens when that happens is the bank loses any interest in having a continuing dimension to the relationship or a future dimension to the relationship. So they're not interested in preserving goodwill. They're not interested in doing business with customers in 20 years' time. Their focus is on extricating themselves from the position, reducing risk, maximizing recovery, and basically getting loans off their books as quickly as possible. And that infects and informs their conduct towards their customers.
And it is shocking if you're a business finding yourself in this position with, as you say, a previously trusted relationship with your bank, and suddenly it all changes. Is it across the board?
It very much depends on the particular motivation at a specific financial institution. Some financial institutions are around for the foreseeable future, and they do have an interest in preserving goodwill, and they have an interest in doing business and in lending to customers, not just now, but in 25 years' time, 50 years, 100 years' time. For other institutions who have made a decision to get out of particular sectors, those factors aren't relevant, and so they don't inform the decision making that happens. From a borrower's perspective, it is extremely unfortunate, because what it actually does when banks decide to leave a sector is it reduces the available sources of capital, and actually is arguably less competitive from their perspective in terms of what they can obtain from lending institutions.
But not only is it economically short-termist, but also just my gut reaction would be, aren't banks unpopular enough already without behaving in this way?
I think banks have had such adverse PR arising out of PPI, LIBOR rigging, the mis-selling of interest rate protection products, that to a certain extent it's water off a duck's back now. The Teflon factor really has kicked in, and I think from the bank's perspective, the most important motivation in terms of its conduct towards its customers is the bottom line actually, and its balance sheet.
So really, as customers, we all ought to be aware that this is what's happening behind closed doors, that really their priorities have changed, and that certainly in some cases, as a business customer, they don't really care.
In some cases that is true. There is a massive emphasis now on the balance sheet and shoring up balance sheets and reducing risk. Paul Tucker is on record as saying that going forward, in terms of the prudential supervision of banks and building societies, the messaging will involve messages along the lines of, your bank is not as strong as you think it is, it's not as financially robust, you need to reduce the risk on your loan book. And the banks and the building societies have already taken that message on board. And it's a very strong message. It's a message that's being peddled by politicians, it's a message that's being peddled by the regulator, and it is a message that has been assimilated and internalized within the banks, and it is being reflected in their conduct to customers.
Okay, so let's put ourselves in the shoes of the customers now. If you're aware that this is the background to the treatment you're going to get or potentially going to get at your bank, how can you best protect yourself?
If I were a customer, I would be very careful in my dealings with my bank. I have seen customers commit themselves to positions in their dealings with their banks and only consult professional advice some way down the line. And often it's either too late or it's significantly more difficult then to remedy a position which could have been avoided if the right professional assistance had been obtained at the start.
I mean, that's really good advice, but in your experience, do you think a bank would respond positively to you challenging them on the terms of their loan agreement?
What I would encourage borrowers to do is to empower themselves, to actively engage, to enrol the right legal or accounting assistance, and to push back, because in certain respects, the banks will concede on points. If the banks are adopting an unreasonable position, and that has been pointed out to them, I've seen numerous examples of a mutually beneficial accommodation being reached. But of course, if you don't ask, you don't get. And the problem is, more often than not, the customers don't ask.
And if things go wrong, if you get yourself into hot water with your bank, how much power have you got then? Is there anything you can do to try and get compensation?
It depends on the nature of the issue. I mean, for example, there has been a lot of publicity recently surrounding the FCA review into mis-selling of interest rate protection products. So it very much depends on a case-by-case basis, but in situations where there has been mis-selling of a product, or a customer feels legitimately that the customer has a grievance, I think it is absolutely imperative to consult with the right people and see whether or not there's a way to take that forward, to see whether or not compensation is achievable, because it is happening and people are being compensated.
Derval Walsh, thank you very much for talking to us.
Thank you.